I want to talk about the midterm exam next week. So the midterm exam is going to be a two-part exam, and I'm repeating what I said before, but I want to do this to make sure we have clarity. It'll be a two-part midterm exam. Part A or Part 1 is Monday. Part B or Part 2 is Wednesday. And just logistically, you will take the exam through ELMS, right? And very importantly, you will take it during the time of the class that you're registered for on ELMS. All right, so right now we are the 2 p.m. section, which means the exam will open at 2 p.m. and the exam will close at 3:30. Right? Now, you'll have 90 minutes to take the exam, both days. 90 minutes on Monday, same 90 minutes on Wednesday. If you start the exam at 2, right now it's 2:13, then the exam still ends at 3:30. So you do not have 90 minutes from the time you start the exam. You have 90 minutes of class time. So if you start the exam late, you are only eating away your time to complete the exam, right? So you must complete the exam both days during your registered class time, because it's not 90 minutes from the time you start, it's during that 90 minutes. At the end of that 90 minutes, the exam, if you have not saved and submitted, will auto-submit, right? And that is going to be a problem if you have not typed in your answers, okay? So here's the thing. Part 1, Monday, Part A of the exam, is just going to be an economic statement conversion. Just like homework 4, just like the practice midterm, you will click on the link under the assignments tab. So go here, go to assignments. You can also go to quizzes. But basically, you'll click on the link for midterm part 1. Once you click on the link for midterm part 1 and you start the exam, question 1 on midterm part 1 is going to be download the data file. All right, so you'll download the Excel file, you'll convert the Excel file, you'll do TII, you'll do TFI, you'll do CFI, and you'll do economic profit. You'll then type in the answers for specific numbers that I will ask for, just like homework 4, and then you will upload your Excel file, right? That is the way, and then you're done, and then submit midterm part 1. So to some degree, I did homework 4 as a dry run, and the good news is nobody came to us and said they had any technical issues with homework 4. So basically, you should be okay for doing the same thing for the midterm part 1. Now, yes?
So for midterm, are we still be able to get the numbers of tax?
I will, just like the format for the homework, I will give you the labels. So you won't have to, it'll look just like homework 4, just slightly different.
Yeah, I remember your video, you mentioned the final, we won't still have the labels.
Right now we're worried about the midterm.
Okay.
Okay, for the midterm, you will have the labels.
Just make sure that is midterm.
For the midterm, you will have the labels. Okay, I have not done the final exam for this semester, so we'll see how that goes. Yes?
Just out of curiosity, on Monday and Wednesday, will you be here?
No. So I told you, I have no intention to just sit here and watch people take an exam for 6 hours. Like, just, I'm not going to waste my time doing that. It's drive me crazy. And so back to this. So what happens is you can take it anywhere. All right, you can take it at home. You can take it here at Van Munching. You can take it in this classroom. What's going to be key is you'll need an internet connection. You need a computer and enough, peace and quiet that you can actually complete the exam. Now, here's the flip side, though. You are subject to the honor code. So very clear. It is an open book, open notes. You will require a computer and Excel to do the exam. However, and this is the key, however, no collaboration of any type. All right? No talking to other students, no talking to past students, former students of any fashion, both verbal and or electronic. That will be considered an honor code violation. And if you have an honor code violation in the midterm exam, it will go to the Honor Council with a recommendation for XF for the entire semester. All right, and so don't do it. It's not worth it. It's really bad for you. All right, so again, I'm not making it difficult. It's open book, open notes, so there's really no reason to do it. If you need any clarification, then you can call or email myself or the TAs. If you have a technical problem, blow up our phones, send us emails, and the key is do it immediately. Like, don't wait. Right? Don't have a technical problem at 2:17 and wait until 5 o'clock to tell us about it. All right? Because, and this is just clear for the entire semester, I just want to be clear because the TAs abide by the same thing. My goal for grading is to do for you what I would do for anybody else. So I believe in consistency. All right? Everybody should be treated in the exact fair way. So if I do something for you, I would have to do it for somebody else. So let's flip this around. If everybody else completes it in 90 minutes and you don't complete it in the 90 minutes, then I can't give you the same grade as the people that have. All right? So here's the thing. With part one of the midterm, when you submit, it's going to auto-grade it. Part of the reason why you're typing in the numbers is it's going to make it good for you that you can actually see the grade. You don't have to wait 2 weeks for the TAs or 3 weeks for the TAs to figure it out. So you'll see the grade in almost real time. The challenge with that is that if you say you have a problem on submission and you have seen your grade, then it shouldn't take you that long to go back to your Excel file and fix the problem and correct it and then submit a corrected Excel file. All right? So here's the thing. If you have a problem with submission, within a minute or two, attach an email and send it. Take a screenshot and send it. Type in data and send it. Call us, right? Because that seems reasonable. If there's 30 minutes, 60 minutes, 2 hours next day before you decide to respond, it just looks suspicious, right? And if it looks suspicious, out of fairness, we have no way to track whether or not that's what you actually were doing on the exam. Or here's another thing. You ran out of time. You couldn't finish the conversion on the time. You tell me there's a technical problem, and then 15 minutes later you're done, and then you actually are ready to submit, but it's too late because the timer has expired. So I'm just telling you, I'm not saying people do that, but unfortunately people do that. And we have no way of validating that. So what I'm just telling you is we have to take the deadlines extremely seriously. And if you're going to have any trouble, and again, it will happen to unfortunately 1 or 2 of you, if it does, you have to basically respond to us as quickly as possible. Because unfortunately, each part of the midterm is 7.5% of your semester grade. And I don't want to see a situation where people get zeros, right? But out of fairness to everybody else, I can't let somebody take an extra 30 minutes to complete it when everybody else has to complete it in 90 minutes. Because the people that basically typed in answers when they weren't finished are going to get an unfair grade compared to somebody else who took their time and then gave us misleading information. And I'm not saying that's what you're going to do, but unfortunately, we can't give you the benefit of the doubt. And the way that I can give you the benefit of the doubt is how quickly you tell us that there was a problem. So tell us there's a problem when you do it. Same thing. If we see inconsistently wrong answers that don't make sense to us that a lot of people have, then I have no way of realizing, like, how did you get to that inconsistent answer? I let the Honor Council sort that out. I don't try to sort that out. And you don't want that to happen. So again, not saying that you won't make the same mistake other people do, but if a whole group of you make a mistake that's really hard to create, that's going to be really bad for you. All right? So again, not saying it can't possibly happen, but don't do this as a group exam. This is not what this is. This is an individual exam. It's not a group exam. And that's why you must individually submit your file in that 90 minutes. Right? Just trying to make it clear and fair to everybody, and this is on the YouTube video. All right, that's Part A of the exam. That all aside, Part A should be pretty straightforward. Yes, sir?
What about access to the exam? Do you have class starts?
The access to the exam will be based on the server timer, and the server timer will be set for start at the beginning of class, so in your case 2 p.m., and end at the end of class, which in your case will be 3:30 p.m. And it has nothing to do with when you log in, because it's a server time. So basically Eastern Standard Time. If you happen to be in the Central Time Zone, you're taking this from Chicago because you went home, well, guess what? You still got to make sure you take it during the right period of time for Eastern. All right, so don't take it in the wrong time because the exam will be closed. Yes?
Will the TAs be in this room say we have other technical or certain things?
Probably not. TAs will probably be in their office hours. Like I said, I'll try and be monitoring, But as I said, we won't probably have somebody physically in this room, right? Because again, I'm not making everybody mandatorily be in this room to do it. If for no other reason, then to be honest with you, I wouldn't want to take the exam with 40 people stuck in this room because it's just not a comfortable environment. Meaning, like, there's just not enough computers and you'd be all scrunched in there. So I'd rather everybody have, space so that you're not constrained. Because again, I'm not trying to put too much pressure in terms of the physical space. I just want you to make sure that you test your understanding. Right, and so that's what I said. Taking it at home, I don't care if you want to take it at a lounge here or conference room in the building, somewhere on campus, whatever. As long as there's no collaboration or cheating, but you do have to take it during class time. And here's the thing, that's part A. Part 2 of the exam will be qualitative. I haven't written it, but there'll probably be 10 to 15 essay, short answer, multiple choice questions. And the whole goal of that is to assess your understanding of what you're actually typing in, right? So again, it's not just about plugging and chugging. It's, do you understand what we've been talking about conceptually in the first half of the semester? So part A, just a conversion. Part B, qualitative. Now, fair game. Anything in the book that was assigned, first 9 chapters, anything in any of the PowerPoint slides, whether we talked about it or not, anything discussed in any class, anything on a video, and anything covered in a homework assignment. Fair game for the midterm exam. So for example, last semester, one of the questions on the midterm exam was explain the difference between the DCF and the economic profit valuation methodologies. Compare and contrast them. We didn't this semester, because the snow day, have time to talk about that, but there's a whole chapter in the book on that. So I expect that you have read it. So again, back to my standard, there's sort of a standard of content we've covered in the first half of the semester, and it's your responsibility to be aware of that content. Now, here's the flip side of this. It's open book, open computer, open notes, right? So with that in mind, as somebody asked me, they said, do I need a copy of the textbook, right? Which is a hint, they probably hadn't read the first 9 chapters. So here's going to be your challenge on Wednesday. You're going to have 11 questions to 15 questions, something like that, and you're going to have an hour and a half. So if you can go to Amazon, buy the Kindle version, download it, read the chapter, and answer those questions, well, then you probably don't need to have read it in advance, right? Because they also corresponding questions, well, how do I study for an open book exam? And I have trouble telling people how to study for open book exams because I don't really know the answer to that, other than be aware of the material. But I think what's reasonable is, hey, I may not remember everything, but at least I remember kind of where it was and I have a vague recollection of it, and then I can quickly go to it and refresh. Like, that's what I would probably expect that you would be doing on Wednesday. But if you haven't covered things and you're doing things for the very first time, you're probably going to struggle. Now, maybe you're some kind of savant, and that's great, but I'm just giving you a heads up that there will be essay questions that you will have to write, and they will cover things that we did not cover in class that were in the book. Right? Yes?
Just wanted to verify, you said Part A is Monday, Part B is Wednesday, and Part A is just connecting those financial statements, download, edit it, re-upload, enter answers.
Yep.
And Part B is purely essay writing.
Essay, short answer, multiple choice. Combination of the 3.
And you might be about to talk about this, but you've shown the format for Part A. How does Part B work exactly?
Well, that's what we're going to kind of go over in class, the rest of our class today. So today we're going to talk about what types of questions relative to the analytics might I asked in Part B. But I gave you an example of what would be a good example of a Part B question just a second ago, which is compare and contrast the EP and the DCF valuation methodologies. That might be a Part A question, right? So understanding the theory type of a question, right? But again, when it comes to the analytics, as I said, we're going to spend the rest of our class talking about that. So absolutely. Yes?
So if we write something out of the book, do we need to cite it or like?
Plagiarism is an honor council violation.
Obviously, we wouldn't plagiarize. I'm not saying plagiarize, but just if you put quotes.
Yeah, just say cited from the book. I don't expect full footnotes, but yeah, it's okay to copy from the book, but say you copied from the book, right?
The footnote will be cited from the book. Since we have time limit, we cannot spend a lot.
As I said, I don't expect, yeah, exactly. Don't take time to give me formal footnotes, but if you copy something, as you said, put in parentheses, Wiley chapter 6 or something like that. So, or whatever it is. But yeah, so that way at least I know that you're not plagiarizing. So again, maybe the Honor Council would say, we'd want you to go further. So I just wanted to say the definition of plagiarism is applying here. But just, if you're using, because in this class, you really do have to use other people's material, right, in order to answer these questions. And that's okay. Just make sure that when you're referencing it, and it's not your own opinion, that it's actually in there. Yes?
You know what?
Go ahead.
Are there overview questions somewhere in the book where we could get an idea of like types of questions we would be asked?
No, because to be honest with you, I haven't done the exam yet.
Oh.
So I'm actually going to make up the exam. And each semester, I actually make up the exam based on what we do in the semester. And what we're doing this semester is different than last semester, so the exam might be different. And I'll give you an example. And based on the frightened looks of the people in the last class, I may not do this, but there is a 10% probability I might. So I was driving into class today, and I was thinking about Part A of the midterm, and I said, a better way of doing Part A of the midterm, without telling you, but now I'm telling you, might be, instead of actually having you do the conversion, to take some of the conversions that were submitted that were completely screwed up and asking you to fix them. Like, that might be a better way of assessing your understanding of this than actually just having everybody convert the statements. So when you have wrong things in wrong places or incorrect signs and unbalanced statements, and then just give you the statements and say figure it out and actually sort it out and make it work, that's probably a better way to actually do this. So I was actually thinking that might actually be Part A of the exam.
Oh man.
But I don't know. As I said, I'm leaning against that because when I told the last class this, like, there was like, that horrified look on their faces. And so I'm not saying it's not fair, but it did influence me that maybe you're not ready for that. But as I said, I'm 90% going to do what I told you. There's a 10% probability I would do that. Because again, it's the same thing. It's just making, actually, in a way, you could argue it's easier because you don't have to worry about cutting and pasting everything. It's already been cutting and pasting. It's just in the wrong place. All right, so that would be an example of Part A. Right? And then the other question that came up from the last class, which I'll repeat here just because I'm doing this on video, is, how long do we have to write the essay questions for? And this is what I related to them as the answer. So I'll just kind of paraphrase this, which is my favorite quote from Einstein is, he's got many, is that a person's understanding of a subject is inversely related to their ability to explain it. Your understanding of something is inversely related to your ability to explain it. And by the way, that's something I always try to live my life by. Right? Is I try and actually make things to be very simple, very clear. But believe it or not, in order to do that, you really got to know what you're talking about. So here's the challenge. When most of you write essay questions, the way you actually write your essay questions, which I hate to grade these, to be honest with you, because I have to read these, is that you basically just pour pages and pages of data in there, and you hope that somewhere in there, I, the instructor, will find a right answer and give you credit. Right? You have no idea whether it's the right answer, so that's the point. You just write and write and write, and somewhere in there maybe is the right answer, and you figure if you write enough that the right answer will somehow show up. But again, it's my responsibility to figure out if it was the right answer. Those are the worst questions, right? And to be honest with you, I'd love to give people no credit for those questions because it clearly shows you have no idea how to answer the question. The best questions are succinct and to the point. Now, let's go to the other side. I don't want you to give me like 3 bullets for an answer. Right, because that's not really an answer, and in a way, it's kind of like the other side of the equation. But the point is, when I say essay questions, it doesn't mean you have to write paragraphs after paragraphs after paragraphs. Like if you can answer the question in a paragraph and it's the right answer, there's no reason to just keep writing on, right? And so the standard that I really want to have is back to that, like answer the question. And whatever you think is appropriate to answer the question that gives a complete answer is really what you need to give. Right? And that's pretty much true in this class. The other thing that's very true for grading in this class is, again, you guys are really smart. And what I found is most people are smart enough that they can write things in a vague enough way that almost any answer could be considered right. Right? So the key in this class is you must refer to data. Right? Because if you tell me something and you give me the actual data that you're using to draw the conclusion, then I know you're right. If you're pointing to the wrong data when you make the right statement, then I know that you really don't know what you're talking about because you're actually talking about something else. So by forcing you to use data, one, it makes you better in your careers. Trust me. But two, that's the other reason why data is so important in your answers. So you must use references to specific numbers when you're talking about things. You'll see examples of this in the next few minutes as we go through the analytics for the semester. All right, I don't want to make this an entire class discussing midterms, but nonetheless, that's really what's coming up next week. After that, we'll come back. We'll do a little bit more. We'll go to spring break. But to be honest with you, once you pass the midterm, almost all of the academic content is done. And really, the next half of the semester, you can decide whether you like it or not, because some people like the academic content, is really going to be about real-world application. It's how do we actually use this stuff in the real world, right, as best as we can try. And that's really what the second half of the semester is. So it's going to be living in Bloomberg. It's going to be living in Excel. It's going to be dealing with real companies instead of these made-up companies, right? But I got to get us to a point that we can all get to that conversation. And oh, by the way, that reminds me of one last point. For the midterm, you don't need Bloomberg. And I'm not going to ask you Bloomberg-specific questions. Because somebody asked in the last class, they said, so you're going to ask us for the definition of certain codes within Bloomberg? And the answer is no. So I'm not going to ask you really anything related to that in terms of Bloomberg, not for the midterm. Okay? All right, so let's talk analytics. If we go to the file that we worked on Monday, and this is the one out of the video, I'm going to go back to the economic profit tab because I think we spent about 6 minutes on Monday creating this tab, and we did it very, very quickly. So I want to make sure that you guys all have an understanding of what this tab is and what it tells you. Okay, so let's start out with the definition of economic profit. Right, economic profit is actually economic value added, known as EVA. So in the mid 1980s, consulting firm Stern Stewart wrote a book called The Quest for Value. It's 800 pages long, and they talked about where they define EVA, economic value added. Now, they also trademarked the term with the Patent and Trademark Office. They got it, so they have a registered trademark. So anytime you say EVA, you have to say EVA is a registered trademark of Stern Stewart and Company, and they generally don't want you using it unless you pay them a lot of money. So the rest of the world calls it economic profit because they don't want to pay Stern Stewart. So EVA is the Stern Stewart term. Economic profit is the same thing. It's the general term for EVA, economic value added. So let's talk about what it conceptually means. At a high level, the insight for EVA that they put into was this. If you think about valuing a project, NPV, what we do is we take the year-by-year cash flows of the project, we discount them, and we sum them up. Right? That's all NPV is. What their insight was, why don't we do the same thing for a company? We take the year-by-year cash flows of a company, we discount them, and we add them up, and that's the value of the company. That's enterprise DCF. What they did with economic profit is they said, let's look at the change in value of a company year by year, and let's add that up, and that's the change in value of the company over time. So economic profit is a one-period change in value of the company. If you sum all those one periods change in values in the future and discount them, you get the overall change in value. So it's really just a way of saying, during a period of time, is the company creating or destroying value? Right? It doesn't mean that the company is worthless or is creating great value because it's the future periods that are going to be added together, but it's just a one-period snapshot. Is the company adding or subtracting value? Right? You then add that to the initial capital, and that's the value of the firm. So in this case, we're using economic profit. We have for 2014 and 2015, negative 46.6, negative 50.72. So here is a question that could show up on part 2. So all the questions I'm about to ask as we go through this analysis are what I'll probably do on part 2. So just to help you prepare for this. So is this company on this spreadsheet creating in the video, creating value? Why or why not? And how do we know? Using the data on this screen. Somebody want to try and answer that? Yeah, go ahead.
I would say it's destroying value.
Okay.
Because it's, well, first of all, just the ROIC is less than its WACC. So that for every dollar invested, they're actually losing money. For, like, the more they grow, the more they lose money.
Okay. All right. So partial credit. You say the same thing, but refer to specific numbers. This is what I mean by referring to specific numbers.
So you see they have a 6% whack on the board.
Yep.
A negative operating spread.
Yep.
Which is the whack minus the
A negative operating spread of,
negative 1.66% 2015.
okay.
A negative 1.35% 2014.
And the reason it's negative is because?
Their ROIC, their return on invested capital, is less than their weighted average cost of capital.
Okay, exactly. So I'm saying, he's saying the same thing, just it's so much more powerful when he actually uses numbers so I can follow along with his statements, right? Because it's very vague when you say this company's destroying value because it has a negative spread. Well, that's a coin flip. You could also say this company's creating value because it has a positive spread. How do I really know that you just didn't flip a coin? So the only way is if I can follow your logic, and your logic is actually correct. But here's the key point. I'm going to go a step higher. All right, in 2015, the company has negative economic profit, and I'll use millions, just easy to talk about, of 50.72 million negative. It is destroying value in 2015. The reason it is destroying value in 2015 is because it has a negative spread, because its ROIC was 4.34% and its weighted average cost of capital was 6%. Right? So that's kind of more of a complete answer that ties it together. But the linkage that I want you to have, regardless of exam, is it's really EVA or economic profit is about spread. So let me ask the question in a different way. If I have a zero spread, what would my economic profit be? Zero. Right? So one of the nice things that people like about economic profit is it just tells you in a dollar way whether your spread was positive or negative. Because if you have dollar positive economic profit, then you have a positive spread. If you have dollar negative economic profit, then by definition you have to have a negative spread. So it quickly tells you with one number whether it's positive or negative. Now the reason why people like Stern Stewart's approach is because it gives you one additional insight that the ROIC does not, which is it gives you the concept of magnitude. Right? I can have a negative spread, but it's trivial and therefore doesn't matter. I can have a negative spread and it's huge and it matters more, but what really matters is how much capital and the spread tied together. Right? Because if I have a giant negative spread with huge amounts of capital, then I'm destroying huge amounts of value. Right? So that's where the dollars come in, but they are related concepts, and that's key to the ROIC. Questions? Okay. So, this company has a negative spread. This company, for both years, is destroying value. Right? Because for both years, it's not making 6% whack. Let me ask a second question. Does that mean this company is going bankrupt? Is this company going bankrupt? If this continues, if they continue on with a negative spread at this rate, will this company go bankrupt? Yes or no?
Yeah.
And what supports your conclusion either way? And you'll probably have to go beyond this page to answer that question. So they stay at this level of negative spread, about negative 1.35 to negative 1.66%. It continues on forever. Will this company go bankrupt? Yes or no?
Yes, because
Why?
they're not, just from this page, I know they're not going to be generating enough cash flow to make those interest payments. Essentially, ROIC is lower than WACC, the cash flow they're generating is lower than the interest payments.
All right. Sadly, that's not the correct answer. And by the way, and I'm not just picking on you for that reason, like that is actually, this question is so hard for actual people in the real world to understand. It's a very complex question, even though it sounds simple. And most people get it wrong because of what they think. And let me give you data here. So here's the point. What's going to cause a company to actually go bankrupt? Yes? Run out of cash. All right? So what number in the converted statements is going to tell us whether or not a company is going to run out of cash? I'm sorry? Yeah, to some degree, the CFI. And if we think about it in an operating basis, then what? free cash flow, right? So it's really, and again, you're right, technically you're right with CFI, but specifically it's free cash flow, right? And that's why free cash flow, take this off, is such a critical number. So what is free cash flow zero? What does it mean to have free cash flow zero? Yeah.
There's no real value being created in the firm
Why?
because there's no cash flows going to investors.
That's right. But what causes, on a very simplistic level, free cash flow to be zero?
A lack of profit.
No.
Spend as much as you make.
You spend as much as you make. Okay, so you equal that out. So that's why there's no cash available to be paid out. All right, but let's go back a second. Free cash flow is the cash available to the debt and equity holders. Take non-operating out for the time being. It's the cash available to the debt and the equity holders. So in 2014, where they had a negative spread and negative economic profit, if 2014 were to repeat itself, can this firm survive? See, in 2014, they had a negative spread, but they had positive free cash flow. And if you have positive free cash flow, you can actually survive. So here's the way I want you to actually think about this, is that there's creating value and there's destroying value. Okay? That's economic profit, economic value added. But there's a third zone. We'll call it the zone of pain. Right? And there's a zone of pain where you're destroying value, but you're generating positive cash flow over time, and you can survive. Right? I'm not saying that your investors are thrilled, but you can survive. Right? And you can actually survive theoretically forever. So what is the bottom? What gets you to that third zone where you can't survive? What causes you to default and go bankrupt?
Negative cash flows and negative spread.
It's actually not negative cash flows. What causes default? Yes.
Not paying debt holders.
Not paying the debt holders. What does not cause default?
Not paying that.
That's right. So if you can't pay the dividend, that doesn't equal bankruptcy. Now, it doesn't mean that the shareholders don't get really upset, and that doesn't mean the board might not try and replace you, but you don't get fired equals bankruptcy. All right? The problem with bankruptcy is it's not defaulting on the shareholder expectation, it's defaulting on the debt expectation. So let's go back to his concept. Yes?
So would we want to, if the company has a negative spread, would we want to look at like their debt equity ratio?
That's one of the symptoms, but I'll keep it even simpler if you think long term, just long term, sustainable. He said the ROIC has to cover the WACC, all right, and that's the threshold for value. The ROIC has to cover the what in order to sustain an ongoing enterprise. What's the actual floor? The cost of the debt. So if my free cash flow is enough to cover the cost of the debt, then I can sustain myself. And if you want to see a real world example, take the North American automobile market between 1980 and 2008, 2009 when they all went bankrupt. Right? Because they went on for 2 decades of basically exactly this. They'd make 2, 3, 4% returns, and they'd have cost of capitals of 8 to 10%, but they had so much cash that they were able to sustain minimum debt payments. You were terrible as a shareholder. You were pissed off. You didn't make any money, but that was the problem, is they could at least sustain themselves. Matter of fact, I would call these the walking dead zombies. Right? They're just walking dead zombies waiting to be put on the misery. So where did the knife to the head come from in 2009? What killed them? They couldn't pay the debt anymore. That was it. You see, that was what killed the Walking Dead, General Motors. That's what killed Chrysler. Is that basically they hit a point where they couldn't cover the cost of debt anymore. And when you couldn't cover the cost of debt, and nobody would refinance the debt, and nobody would give them any more money to fund that debt, they didn't have a choice. Right? So that's the key, is that you can destroy value and stay in business as long as you cover your cost of debt. Right? Or if you have negative cash flows and people are willing to lend you money. But if you go long term, people are going to be less willing to lend you money when you're destroying value, right? And so that's kind of the other thing to keep in mind when we think about a firm and value creation. Yeah.
So you said the key is comparing the cost of debt to ROIC.
What I'm just saying is on an operating basis, sustained over time, not talking about one period, sustained over time, you better cover your cost of debt. Because when you don't cover your cost of debt, and this is key, banks look at free cash flow as well. Because free cash flow is the cash to the debt and the equity holders. And what they're going to say is there enough cash flow to pay that debt? When you can't pay the debt anymore, well, then even the banks are not going to lend it to you. Now, here's the caveat. If they think you're going through a tough time and they think that you're going to eventually do well, then they'll lend you to cover that hole before you can then, as long as they think you can fill it. It's when they don't think you can ever fill it, that's when they actually won't work with you, and that's where you go Chapter 7 versus Chapter 11. But what's going to cause them to think that is, as I said, you can't even cover the cost of debt on a sustained basis. That's what's going to be key to going bankrupt. Yeah.
Can we see the ROIC covering the debt in the equity?
Can we see the what?
Can we see the ROIC covering the debt in the equity?
Well, in this simple example, I gave you a whack. So what we would really need to do, and you can see this clearly in Bloomberg, is go to the WACC screen in Bloomberg, and you'll clearly see a cost of debt and a cost of equity. And you'll see the after-tax cost of debt. That's the minimum threshold long term. And as I said, and this is key, and we'll be very subtle here, it's not the year by year. It's over time. So I'm saying over time, you better cover at least your cost of debt. That's how you stay in. When you go below that, then you can't survive. All right. So with that in mind, let's go back. That's why free cash flow is really key. All right. So what do we know about this firm based on its CFI? Oh, sorry. I skipped over one point. Just because this is on the video. That's economic profit. There's something which we call BOY, beginning of year economic profit. And I want to talk to you about why we're using BOY, B-O-Y, versus EOY or average. Right? And again, I'll start conceptual. So one of the theories with capital is basically for return on investment, I want to know how you do on the investments that you make. So if I take the beginning of year method, the assumption is this. If I start building a new building, do CapEx or a plant, well, if that plant's in progress, then I'm not really using that plant to make my sales. So it's going to distort my real return view of the firm if I look at the in progress stuff with the stuff that already exists, because it's the stuff that already exists that's going to lead to sales and profits. So if I think about taking a beginning of year economic profit, the rationale for doing that is basically to say, I want to know when the plan is built what types of returns I'm going to make on existing assets, as opposed to mixing stuff that's not actually being used with stuff that's being used. That's why people use beginning of year ROIC. So they'll say, look, I'm putting CapEx into place. During this period of time, I'm probably not going to see sales out of that. So let's exclude that from the calculation and see what the sales and profits are on the assets they're actually using to generate those sales and profits. That's why people use beginning of year ROIC. End of year ROIC. This is the other side of it. And they use this too. I don't care. I don't care if you're in the middle of building it, and I don't care if it already exists. I lent you money. I want to know what kind of return on the money I gave you. So end of year basically doesn't discriminate between existing and non-existing. End of year just says, I gave you money, you're on a clock. The longer you keep the money, the more you owe me. So tell me what my return is on the money that you're employing, and it is your responsibility to efficiently use it. So what is my return on that? Return on end of year capital. Then you have return on average capital, beginning plus n divided by 2. Hybrid. It's halfway between the two. It's like a compromise approach. People use all three, right? And I'm not saying one is better than another. It is a little bit situational in terms of what you're trying to answer as a question for the business. Does that make sense to everybody? As an essay question, you could answer that?
Can you explain it one more time?
Which part?
Like, very succinct answer to read, like, why we would want beginning the hybrid.
Why don't you explain it to me? I could do it. I just did it. It's actually on the video, which is good. So you help me see what your understanding is. Test it.
So end of the year ROICs to see how they performed in capital during the year.
Capital during the year plus what already exists.
Plus
It's all capital.
And then, I don't know, was a little bit confused on like what the big difference would be in the beginning, the hybrid, because isn't it an ongoing basis?
So, like I said, let's just take, are they building another building around here? They seem to be building buildings everywhere around this damn campus. Is there another one around here going up? For what? Is it academic building or not?
Both housing and
All right, so here's the point. If I'm the university, I manage the university, and I'm looking at how efficient I am at using my university resources, then do I want to include the academic building and the houses when it comes into analyzing my business? So the first thing is, okay, well, nobody's in those dorms that are being built. Nobody's actually having classes in what's being built. So when I look at the effectiveness of my utilization at Smith, I exclude it. That's beginning of the year. But then the other side of it is the General Assembly comes back to the president and says, but we gave you $300 million and you're putting in these buildings, so tell us how we're doing at our $300 million, and whether you're building new buildings or whether you're doing existing, I really want to know what my return on education is, so I care about an end-of-year approach. And then basically what the president goes back and he says is, well, yes, but I know it doesn't take us forever to build every building, and some of them are being used, so why don't we kind of meet in the middle, and we'll take an average approach to say it doesn't take a full year to build everything, so therefore I'll have some stuff going into play, so we'll kind of meet in the middle and call it a hybrid, return on average capital. Okay, and that's really the point. And to be honest with you, when you use one versus another is the nature of the business. So if I have a service business that doesn't really build a lot of things, and I'm just like, buying laptops and IT systems that's quick to churn out people and hire them, then I don't really need to use beginning of year capital. I could use end of year capital, and that's perfectly fine. If I'm a chemical company and I'm building a $1 billion, it's called a cracker, which literally cracks the chemical into pieces so that they can make plastic, and it takes 18 months to 2 years to build this thing, then using end-of-year capital may not be a true representation of how the chemical company's doing, because it might take 2 years before they spend the money before they see any sales. So I might use a beginning-of-year capital to get a better representation of how they're actually doing on their actual chemical business, because I don't want to distort a giant investment that's going to take 2 years to pay off before I even see any revenue, and mix that in my current assets. So again, that's where I might use an end-of-year approach. And so that's the point. The reason I'm using it, I should know why. All right, now here's the point. Academically, arbitrarily, I'm trying to show you something different. What I'm trying to show you this semester, and this is actually another important point, it doesn't matter what method we use to value a company. There's one value for the company. Just because we change our methodology should not change the value of the company. So what I really want you to understand is all these different methods should come to the same answer. It's just rearranged equations, right? And so basically, when you think about what's the difference between the DCF and the enterprise economic profit valuation methodologies, it's rearranged math. And you get the same answer when you rearrange the equations. You have to. Matter of fact, when you do multiples, same thing. If I do multiples, price to earnings multiple, enterprise value multiple, I have to get the same answer as if I do a DCF. Otherwise, I'm making a mistake. So they all have to give the same answers. And that's something you will learn before you leave this class. Right? And a lot of people in the real world have been out there for years doing finance, and they still don't understand that the DCF and the PE are the same thing. Right? They actually think they're different, and they're really not. And you will understand that. So let me go back. So here's the thing. If you use beginning of year ROIC, and if you use beginning of year capital, the DCF and the EP match exactly to the penny. If you use end of year capital and end of year ROIC, or average capital and average ROIC, the DCF and the economic profit valuations come close. So for purposes of your exam, I want to show you the academically exact to prove that point. But for analytics, we may choose different analytics for understanding different natures of the business. So again, that's why I'm using beginning of year ROIC, because I'm setting up when we do the valuation model right after the midterm, is that you will see that you'll have two tabs in your Excel model, and both tabs will give you an identical answer. All right, and that's what's going to be important for you to understand. All right, so that's BOI versus EOI. So let's go back to the cash flow. So free cash flow is the cash available to the debt and equity holders from operations. What can you do with your free cash flow? Assuming you have positive free cash flow, 2014, what can you do with it? Conceptually. And I'll give you a hint. It's three things. There's three things you can do with your free cash flow in general. Yeah.
You reinvest
No. Now, I would answer that question differently outside this class. I'm being harsh because in this class, technically no, because free cash flow is after reinvestment. So by definition, you've already reinvested in the operations. So what are the three things you can do? Yeah.
Give it up.
You can give it to the equity holders, or, and his answer should help signal the other two,
Paying the earnings.
I would call that giving it to equity holders. Retaining the earnings would then go to
Like for next year's.
excess cash. You can put it into savings, excess cash, which is a non-operating activity, or you can pay the debt holders. Those are the other three parts of CFI. And that's the way I want you to think about CFI, is that at a very high level, there's three things you can do with free cash flow. When you have free cash flow, you can either put it into savings, excess cash, you can pay debt, or you can pay equity, or some combination of those three. When you have negative free cash flow, 2015, what's the opposite? You need cash. Where do I get the 355 from?
From the access.
That's cash.
I either draw down my savings, or I issue new debt, or I sell shares. The opposite is true, or some combination and permutation. Now we can get crazy because what some companies could do is they could say, "What I'll do is I have negative free cash flow and I'll issue debt, but I'll sell shares." So they'll do all three, or they'll say, "I'll have negative free cash flow and I'll buy back shares, but I'll issue debt to cover both." Right? And so what I want you to think about is there's really four buckets of cash. All right, so we've got the first bucket's dumping the cash into the firm, and assuming it dumps the cash in the firm, where to go? And there's three areas it's going to go. Those are the three parts of CFI. The flip side is, if I got to fill my bucket, it's going to have to come from one of those other three buckets. And that's what this statement is telling us about the firm, very clearly about where it's coming from and where it's going. Now, the other thing is we have to have some insight into not just the whole number, but what's happening that leads to the whole number. So let's go back to free cash flow. Why does the business have positive free cash flow on this Excel sheet that we did the conversion for in 2014? Why does it have positive free cash flow in 2014? What's causing it to be positive? And I'll ask you as a compare and contrast if that helps you. Why is it negative in 2015? What changed? Somebody different. Yeah.
Is it for negative gross investments?
All right. Exactly. So it's not negative gross investment in 2015 or 14.
2014.
So what does the negative 178 gross investment tell you in 2014?
You probably cut on your investment.
Well, it's not just gutting. Did they actually spend money on gross investment?
But it,
They actually disinvested in the business in 2014. So now go one level down. Why was it negative 178 in 2014? What caused the company to disinvest in 2014? Somebody can help him or he can answer it himself. What caused it to be more negative? Yeah. Yeah, they didn't pay somebody. They basically had $300 million of liabilities they didn't pay. Well, is that sustainable? Good finance is storytelling. And there's a story to be told here, and you're going to start to learn how to put together the story of what's really happening with a firm. Because this is how sell-side analysts are able to walk into a call and ask so many questions that seem relatively insightful, because they know what's happening in the financial statements, and then they're looking for clarifications. Right? Matter of fact, that's one reason why they disinvested. What's the other reason? What's the other second very important reason? In 2014, this company had negative 178 in gross investment. That could be a challenge for them. Yeah. All right. To some degree, negative working capital, but I think there's one thing that's more important than the negative working capital here. That also really helped their cash flow. Because working capital helped it, but this one helped more. Yeah.
Capital expenditures.
What? What about the capital expenditures? You're exactly right. What about the capital expenditures?
They didn't spend that much in 2014, so it's
Define that much.
relative to the next year.
No, I'm just saying how much.
20.
Thank you. So they spent 20, but why can we say it's not that much? Because 20 could be a big number to a lot of people. So why can we say in this case that 20 is not that much? Because there's something in here that screams it's not that much.
That the next year is 660, which is.
So number one, they say the next year a big spike up. But there's something even more important. Yeah.
Depreciation.
Depreciation. What about it?
It's less than depreciation.
So here's a very important rule to keep in mind. Okay? It comes from accounting. And it comes from straight line depreciation. If I buy a building and I depreciate the building over 20 years, that means I take 1/20th of the building and I write it off every year. Well, flip it around. It means I probably should be spending 1/20th of the building's value to what I would call tread water, to stay in place. Right? So one rule of thumb for a business is they have to spend their depreciation to sustain their existing assets. Not saying it always works perfectly true, but it's a rule of thumb. So the company should be spending about 220 to just maintain its current ability to sell and do things. The company is spending 20. Well, that's a big red flag there, right? Because it should tell you something's going on, right? Something's going on that says, you know what? Maybe they got too much capacity and they don't need to spend it. Maybe something's going on to say that they're performing poorly and they've decided not to put anything back into their business, which means it's going to start to crumble in the future and they're probably going to have to spend more in the future, right? And that relates to 2015. Because 2015, we see a big spike in CapEx, right? And one way to interpret the big spike in CapEx is, why would I buy a big plant? What could cause me to want to buy a big plant? Why would I build a new plant? I'm growing my business. So one thing 2015 could be signaling is that they grow their business. But I'll give a student credit in the last section who gave up an insight that I didn't even pick up on, that I thought was a really good one, which is he said, maybe 2015 is just making up for the lack of investment in 2014. So maybe it's not that they were trying to grow their business. Maybe they just skipped a year and they had to catch up, right? And I'm saying that's actually a really good insight. And here's the point. Either one of those two could be true scenarios. That's where the analyst goes in and talks to management and says, here's this. But that's the point. We now have some issues going on with the company. But let's go back. Let's put these together. What kind of spread is this company getting? Negative. And then, on top of that, what are they doing? They're putting this big bet on capital. So our bias is going to be either they're in a recession and they expect boom times ahead, and maybe it will pay off and they have to spend it now, or maybe they're just a poor company and when they do all this investment, it's just going to lead to more value destruction in the future because they're not in a really good business, and basically they're just throwing more good money after bad. And that's going to basically help our assessment of what the value of the firm is going to be. And this is what I mean by storytelling, is we start to put the pieces together to start to get some insight into what's happening with these companies. Does this make sense? Oh wait, all of this, that's Wednesday, just so you know. All right, so back to this. Let's talk about some metrics to further help us. And I'm going to give you one metric right here on this page. It's called the reinvestment rate. We defined it earlier in the semester. I'll remind you of it here today. So right here on line 13, I'll write reinvestment rate. And reinvestment rate is defined as gross investment divided by gross cash flow. That is the reinvestment rate of the company. So, what does that tell you? What does the reinvestment rate tell you? What does a reinvestment rate of 100% mean?
That means they put profits from previous year into investment.
Yeah, that every dollar of gross cash flow, profit, we'll call that profit, every dollar of gross cash flow was basically put back into the business. That would be 100% reinvestment rate. So what does it mean to have 190% reinvestment rate?
They invest with that.
I'm sorry?
They invest with that.
Yeah, they almost doubled what they're generating cash flow. So again, back to signaling effect. If I'm spending 190% of my profits, I have to believe that there should be some growth in the future. Right? Otherwise, why am I doing that? So there's probably an expansion that's happening at this company that I should be looking for. What does it mean to have negative 47% reinvestment?
They got the money now.
Yeah, not only are they not investing, they're actually taking money out of their business, right? Now, somebody mentioned working capital earlier. If they take $43 million out of working capital, well, that actually helps the business because they're more efficient and they don't need it. But eventually, they run out of working capital to take out. So there's some savings for working capital, but you can't take working capital out forever because then you actually go into negative inventory, which starts to not make any sense. So yes, working capital can help you, but it's not long-term sustainable, right? But nonetheless, reinvestment rate is, if you're not reinvesting it, you're paying it out. So what is their ability to pay out in 2015? Do they have an ability to pay out? Not really, because they got to go find the 90%. Well, there's CFI. What's their CFI in 2015? Well, after non-operating cash flows, which is primarily excess cash, they ended up with 227 million negative. So where'd they get the cash from? Where did the cash come from? To fund this. It was the issuing of the debt and the issuing of the preferred helped fund this negative free cash flow, which helped fund this CapEx. Right? So I added a tab, which I'll post later, called metrics. And these are the metrics that will help you get better insight into these converted statements. Right? So very quickly, I'm going to wipe out these metrics so that you can recreate this yourself if you choose. Let's just clear what's already here. All right, so what is operating ROIC? All right, operating ROIC equals, from the TII, NOPLAT, which is our operating profit, divided by TFI, invested capital. What is non-operating ROIC? Non-operating ROIC equals, from the TII, non-operating profits, non-operating income, divided by, from the TFI, non-operating capital. So on operating activities, they made 6.3%. On non-operating activities, they made 11.6%. The average of both, return on TFI, which is not really a commonly used term, so I just made it up, right, equals total income available to investors divided by TFI, total funds available to investors. That's the weighted average of the two. And by the way, that's 3 years worth of data. Now, what we can see in all 3 years is the returns are dropping for the company across all 3 years, from 6.3 to 3.7, from 11.6 to 5.2, from 6.7 weighted average to 3.9 weighted average. So the performance of the business is getting worse. By the way, definitionally, in Bloomberg, if you look up return on invested capital, not what we put in, but the standard definition, Bloomberg, they don't call it this, is the ROTFI. Because if you look at net operating profit after tax in Bloomberg, again, not the NOPAT that we put in as a custom field, but the default field in Bloomberg for NOPAT, the way Bloomberg calculates it is TII. It's not NOPLAT. That's why we put in a custom field of EBIT after tax. Because what they're doing is they're taking profit and they're taking out the adjustments for interest. They're not taking out the non-operating items in Bloomberg. So we would have called that TII. What is Bloomberg doing for capital? Bloomberg for capital is doing debt and equity. Well, that's TFI. So really, if you think about the way Bloomberg is doing ROIC, it is this kind of return on total funds available to investors. All right. They make one additional adjustment for cash, which we'll talk about later. But conceptually, this is really more of what the rest of the world is using. And what we're trying to do is we're trying to get insights into, they look at the average, and we're looking at the two things that drive the average. Reinvestment rate, previous screen. Gross investment equals, go back to cash flow available to investors, gross investment divided by gross cash flow. What percentage of the profits are reinvested? Free cash flow, dollars of free cash flow. Am I generating more than I spend? Right off the CFI. Growth rate in sales, right? Well, what is my revenue growth rate? That's just math. I take current year sales minus previous year sales divided by previous year sales. Okay. Operating return on sales equals, and I can do this for all 3 years, equals my operating profit after tax, we call that NOPLAT, divided by financials, sales, revenue. That's my margin on operations. Cycle time equals invested capital, so I go back to my TFI, divided by sales times 365. That's days. That equals my ROIC from operations. So here are my, I was jumping size here. Here are my operating metrics for this hypothetical firm that was made up that we just created. All right, so let's talk about performance between 2013 and 2015. Look at ROIC. In 2013, the business made 12.8% every 743 days for a 6.3% annual rate of return. In 2015, it made 6.8% every 664 days for a 3.7% annual rate of return. Is it getting better or worse? It's 2015 or 2013 better? What's better? So it's getting worse. Why? Why is it worse in 2015 than 2013? Yeah.
The margin went from 12.8% to 6.8%, and the revenue growth went from 8.8% in 2014 to 5.4%.
So they have lower margins, the growth is slowing, and though productivity increased between 13 and 14, it got worse between 14 and 15. Why did the productivity, cycle time days, improve between 13 and 14? And it has to do with invested capital relative to sales. What happened to their invested capital in 2014? Free cash flow was negative because gross investment was negative because the company didn't spend any CapEx and it didn't pay a bill. That was the direct reason why the productivity of the company improved. Why did the productivity worsen? Because the company spent a huge amount of capital relative to its sales and profit growth, which caused the slowing of the company in 2015 and therefore hurt its ROIC. All right. I got 4 minutes left, and this is what I want to show you. Show you a second spreadsheet. After the midterm, we're going to create a valuation model. This is the valuation model that we'll create after the midterm. It's a very complicated spreadsheet. This is the one we created in the fall for McDonald's, right? So this is 5 years of historical CFI for McDonald's, real McDonald's, right? Put into our format using their actual data. And this was in the fall of last year, so their 2015 results had not been released. So what I want you to do is I want you to look at this screen, and I want you to look at their free cash flow, and I want you to tell me how is McDonald's doing over this 5-year period of time. Using real data. You're the analyst. There's their free cash flow. How are they doing? Particularly in 2014. How are they doing? Over 5 years and in 2014. How are they doing? Look at the free cash flow. How's 2014 free cash flow look to you? Yeah. So they're reporting record free cash flow. So that's a watershed moment that this is the best year McDonald's has probably ever had. Look at all this free cash flow we had. Why did the free cash flow go up so much between 2013 and 2014? Almost $1.2 billion. What caused it to go up? Yeah.
They rapidly decreased their capital expenditures.
Yeah, from 2.6 billion to 454 million. What is McDonald's reinvestment rate?
11%.
And what has it been?
30%.
It's been the 30s, right?
Yeah.
And then suddenly it went to 11. And oh, by the way, what was that depreciation rule of thumb I told you? What's their depreciation?
It's depreciating faster, then you'll lose money.
Well, just if they're spending $1.6 billion on depreciation and they're putting 454 million in new capital in, they're not covering their depreciation. So what can we assume about McDonald's expansion?
Increasing.
That's right. So what's happening to their gross cash flow, which is a proxy for their profit?
Increasing.
So the profits are going down, but their free cash flow is a record because they stopped spending. As a matter of fact, they cut their reinvestment dramatically and slowed their store growth. By the way, while they were announcing this, what did they do with the $6 billion worth of free cash flow? Look at the 3s and the 4s. What did McDonald's in 2014 do with the free cash flow? They spent how much on share repurchase? 3.198 billion. They paid how much in dividends? 3.216 billion. Those two numbers, 3.2 is 6.4. How much free cash flow did they have? 6.1. Where did they get the difference? They issued debt. Here's the insight I want you to have. McDonald's, and the analysts missed this. McDonald's in 2014 had the best year it ever did for free cash flow. McDonald's announced a giant share buyback. McDonald's distributed $6 billion back of cash to its investors and said, look at our glory. And what I'm telling you, and this is 2020 hindsight, is if you look at McDonald's, we see some red flags here. And the red flags that we should have noticed that none of the analysts asked about was that McDonald's cut their reinvestment rate to 11%. And that is why they generated so much free cash flow. And it was all covered up by the cash redistribution. And I'm telling you, in 2015, what were the headlines on McDonald's? Sales problems. Same store sales are down, and we're having trouble getting people to come to our locations worldwide. And I'm telling you that they knew this was happening before 2015, and that's why they slowed down their investment. And if we were smart enough to pick up on that in the cash flows, then we would have seen a year in advance of McDonald's problems that were already starting to show up in the cash flows. And by the way, everybody missed this, right? What did McDonald's do this year to fix the problem? Because the new CEO took over for the old CEO who had these great numbers, and he felt with declining sales and all the problems. How'd they fix it short term? All day breakfast. Is that a 10-year fix? That's going to be the next question. This is where we're eventually going to get to. But this is the type of insight that I want you to have. And this is the analytics that you're going to be assessed on next Wednesday. Okay? Good luck with the midterm. I'll see you guys when you have.
What is that?